This is the Asia Trade. I'm Shery in Bloomberg's Asia headquarters in Hong Kong.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. A weak lead-in for Asia as Walmart's disappointing forecast adds to concerns over US consumer spending. Big bank shares also taking a hit. Alibaba surging, though, as it touts an AI-led strategy for the fastest revenue growth in more than a year, driven by e-commerce and cloud services. And the Treasury curve flattens as Secretary Scott Bessent tells Bloomberg that any boost to the share of long-term debt is some ways off. And the reasons he sort of said that, really citing hurdles, including quantitative easing from the Fed, the current sort of elevated levels of inflation. So Scott Bessent really saying, any kind of plan when it comes to boosting the share of longer-term treasuries in government debt issuance is really some time off. He obviously also addressed some other topics across this conversation in terms of the inflationary aspects of Trump trade policies and the such. We also did hear that the Fed is currently, shrinking its own holdings of treasuries, creating a competing seller of debt to the market. It said it would be easier to extend the duration when it's not seeing that competition. Take a listen.
That's a long way off. And we're going to see what the market wants. The Fed said that they may stop their balance sheet runoff. So, easier for me to extend duration when I'm not competing with another big seller. It's going to be path dependent.
And the thing is that Secretary Bessent had repeatedly criticized then Secretary of Treasury Janet Yellen, but it seems that he may be taking her same approach, especially when it comes to those forecasts of where the inflationary trend might be going from the U.S. Are they perhaps too optimistic? Take a listen.
Everything that President Trump's administration is doing will be disinflationary. We're going to bring down energy costs. We're going to bring down regulation. What DOGE is doing in terms of cost cutting. And I think once the Tax Cuts and Job Act is made permanent, then we can have a revenue increase, cost decrease. And as you said, as the nation's top bond salesman, I got a pretty good story.
Bloomberg Opinion columnist Jonathan Levin joins us now for analysis of these comments. Jonathan, good to have you with us. Of course, really, U.S. debt issuance is one of the most powerful tools that the Treasury Secretary has at his disposal. But you think that some of the assumptions that he's making and what he's doing right now might be disingenuous?
Yeah, that's exactly right. Great to be with you, Shery and Haidi. I think what we've learned here is it's a lot easier to criticize people when you're on the sidelines. But once you're in the seat, you go for the easy answer. And what is the easy answer right now? I think this administration understands that it is going to sink or swim with the yield on the 10-year. If it doesn't get the yield on the 10-year lower, it's going to struggle with consumer confidence. It's going to struggle to make the American people feel like they're getting the change that they voted for. And if Secretary Bessent were to come out and sort of take his medicine, so to speak, and start issuing more at the longer end of the curve, well, you can certainly bet that things like mortgage rates, things like corporate credit are going to get more expensive, and that's sort of the last thing he wants to do. But is it hypocritical, given what he said about Secretary Yellen? Yeah, it's absolutely hypocritical.
There's a lot in terms of Trump's set of policies, from trade to domestic policies to immigration, that is fanning a lot of these inflationary concerns.
Yeah, that's exactly right. Secretary Bessent's comments, as you say, sound pretty disingenuous when you look holistically at what the Trump agenda would do to inflation expectations. Tariffs, there are a lot of open questions as to how those would be ingested into the U.S. economy, whether or not it's going to be more of a drag on certain parts of the manufacturing sector, or whether or not those things may pass through to to realized inflation. But what we know is that the tariff agenda is already affecting inflation expectations. And inflation expectations, as economists have been telling us for decades, are fundamental in the path of realized inflation. I think you add to that the fact that this administration is trying to do deficit funding tax cuts to the tune of $4.5 trillion. It's hard to go out there and make these arguments that Secretary Bessent's making.
So, Jonathan, how does it compare to what Secretary Yellen did in the past, especially in her early years and latter years, and how defensible were her policies?
Yeah, well, I think in the early years of the Biden-Yellen government, clearly we were living through the pandemic. We had ultra low interest rates, and the government prudently, extended maturities. In 2023, 2024, that was where we started to hear a lot of criticism from Republicans, from conservative politicians who said that the Yellen government was essentially offsetting the effect of Fed cuts and messing with our fiscal future by financing itself in short-dated Treasury bills. I, at the time, did not think that criticism was valid because she was essentially expressing what was a consensus opinion, which is that rates were elevated at the time. Inflation was elevated, but it was going to get better, and she was going to have a better opportunity to sell long further into the future. Ironically, Secretary Bessent does not have the same excuse because consensus expectations for inflation have indeed been drifting up. And some in the markets, I got to say, it's not necessarily me. I'm a little bit more optimistic than the consensus, I think. But some in the markets are saying that we are, in fact, going to have to live with higher for longer borrowing costs. And so if that's the case, if you believed that, what is the justification for Secretary Bessent's decision? Again, I'm not necessarily saying that I would do it differently, but I am saying it's awfully hypocritical.
Bloomberg Opinion columnist Jonathan Levin there. Thank you so much for that insight. Take a look at how we're setting up for the Asian market opens, because the Japanese yen is what we'll be watching, headed towards that 145 level, 149 level right now. We have crossed the 150 threshold. CPI data, half past is what you'll be watching, because that could be hot. Could we see more yen strength against the U.S. dollar? And of course, we are setting up for the market opens in China in a few hours. Do watch out for those Chinese stocks. We actually saw the Golden Dragon Index gaining ground to the highest level in about a week. Really, Alibaba stocks surging overnight in New York, biggest intraday gain in almost 2 years. And this is, of course, what's been happening in the ADRs market overnight in New York. Alibaba really surging after those results that we got. Fastest pace of revenue growth in over a year. Let's get more with our tech reporter Annabelle Drewlers, who can unpack all of this, because really there was so much optimism, or at least expectations, about how AI could fuel growth for this company.
Yeah, I think expectation is probably the right word there. I mean, there was a lot of hopes, I guess, that all of the optimism that we'd seen around Alibaba's stock would actually pay off in the numbers. But actually, it kind of did. I mean, we've seen this company really pursuing a back-to-basics model under new leadership, and it's been a really transformative time for the business as well. But breaking it down so you can see here, so you've got those two key divisions, like you said. You've got the e-commerce side, so that's the core Taobao, Tmall businesses. We saw sales here growing strongly, so growth around 9%, really led by AliExpress. Once again, the standout here, and we've seen that at 30% growth. It's been a very strong business for Alibaba. But actually, in the Q&A, if you listened into the call, what really took a big backseat was the e-commerce business. The main focus was on what's happening in their cloud business. And again, this was very interesting. We saw the cloud revenue growing by 13%, so it was better than expected, the fastest pace we've seen in 2 years, but triple-digit growth, rather, in AI-related products. And executives are saying basically there is more to come in this area. The AI era is only just getting started.
I mean, it's so interesting from the traditional business model that they had. and now they are this like trying to be this AI company. Yeah, tell us a little bit about that.
I mean, yes, exactly. There's sort of. They are an e-commerce business by nature, but they're certainly moving very much more into this cloud era, AI era as well. And actually, when you take a look at their planned investment, for instance, they're saying cloud and infrastructure over the next 3 years is going to be more than they've spent in the last decade. So they're spending or planning really big spend in this space. AGI, this is actually something that came up, and the CEO, Haidi Wu, he said this is going to be their first and foremost goal, artificial general intelligence. We do need to put a bit of caveats around that. This is something that's very powerful, but it's also a hypothetical AI system at this age, and some would say that AGI is decades away, perhaps never could eventuate, but still it tells you how much they're really focusing on AI, how much potential they see in this area as well.
Annabelle Jewellers there. Well, big US tech has pushed back hard against the market splash that China's DeepSeek made just a month ago, with Nvidia and other AI darlings regaining nearly all of their lost ground. A Bloomberg Opinion columnist John Author says the Chinese startup may be less white whale and more wannabe. He joins us now from New York. And John, clearly we've seen the bigger impact in terms of the boon for China tech, right? You can just see that with what we've been talking about with Alibaba. But when it comes to, you know, the sort of David and Goliath, or I guess I'm now mixing, you know, literary metaphors, as you've been talking about Moby Dick, is it less sizable? No,
there's obviously a huge amount at stake with the attempt to grow out AI. In the last 2 or 3 weeks, the tech establishment in the US, the tech investors, have largely managed to convince themselves that DeepSeek isn't as alarming as they thought, that DeepSeek, the mere fact that it's shown that it can do this, that it's possible to make models more cheaply than had been thought, means that maybe there'll be even more demand for data centers and chips, because even more people can get into the game of creating the models. So as it stands at the moment, there is not necessarily a wholly coherent and or wholly believable argument that this isn't a problem for US tech, that it could almost help. Certainly, when the effect on the share prices of direct data center companies was quite remarkable. They took another leap further forward on the DeepSeek news three weeks ago.
Yeah, so it was a blip. We are seeing all of these sectors affected by AI return to levels pre-DeepSeek. What are the expectations now that we are seeing AI infrastructure expectations continue to be what they were before?
Well, in terms of what the expectations are, I guess it's whose expectations. It certainly strikes me that you don't get a reaction like the reaction we got on the day of the DeepSeek shock. Nvidia's market cap dropping from memory $600 billion in one day. You don't get a reaction like that unless people aren't totally confident about the assumptions they've been making about the market, and if there isn't at least some considerable room to doubt whether those assumptions are firm. I think there have been arguments about whether DeepSeek has really managed to deliver all the DeepSeek, the app itself, can really deliver all that it says it can. But more broadly, I think you can see that there is at least some discomfort with whether whether markets are penciled in rather too much or typed in too much into their spreadsheets in terms of their assumptions of the growth that we can see from AI for the future. And I suspect that the big news of the next year is basically going to be, we need to see that somebody somewhere is actually using AI to improve their profits. And if you don't see that, then there will begin to be very great nerves about the sheer scale of the capex that has gone on much more in this country than in China. There is if you look into the guts of which stocks are doing best among tech, it's those that have shown that they can deliver profits rather than necessarily those that have spent the most on capital expenditure. And that's because there is this concern that maybe this money isn't being well spent. But that was the great concern that DeepSeek raised, and it's not gone away completely, even if people are feeling calmer about it for now.
John, really great to have you with us. John Authors, our Bloomberg Opinion columnist there. Let's take a quick look at one early mover that we're seeing just about 15 minutes into the start of trading here in Australia this Friday. Domain Holdings, this is the online property portal, seeing quite a bit of upside there as we are seeing reporting that, or rather a confirmation that CoStar Group, this is a US real estate analytics firm, offering to buy Domain in a deal valuing the business at about $1.7 billion US dollars, or 2.65 billion Aussie dollars. They've offered $4.20 Aussie in cash for the rest of Domain after buying almost 17% of the stock on Thursday for the same price. Domain's board is currently assessing that offer. It's 35% above the stock's closing price of $3.12 on Thursday. CoStar wants exclusive due diligence before any deal goes ahead. So it really just continues this theme of kind of global waves of consolidation and takeover attempts that we've seen across the property space. Rates, of course, have started to fall in Australia. That was just this week from the RBA, and of course in the US as well. REA Group is the main rival in Australia, and that's also made several offers for UK's Rightmove last year. So we continue to watch that stock, a big mover so far in the session. Well, coming up on the Asia trade, Wedbush Securities joining us for more on AI spending trends in Asia. We'll also be speaking to Lazard when it comes to market strategy. Much more ahead on the Asia trade. This is Bloomberg.
Citigroup is scaling back its diversity policy, citing pressure from the Trump administration. The bank will no longer have aspirational representation goals except those required by local law. Bloomberg Simone Foxman joins us now from New York. Simone, so, I mean, how vulnerable are these companies to these pressures from the Trump administration that they have to be forced to make these changes so quickly?
Well, if you're a federal contractor like Citi is, and like many of the large companies in the U.S. are, you're extremely vulnerable. Trump's executive orders set out a couple of things, but one of them was that anyone doing business with the government has to promise that they are not doing any, quote, illegal DEI, diversity, equity, or inclusion programs, and affirm that, and then also instructed various federal agencies to actually draw up a list of companies that they oversee or are in their remit to go investigate for policies that promote diversity, equity, and inclusion. Now, I think it's important to note that the companies themselves, including federal contractors, no one thinks they're breaking the law. But if you're Citigroup and you have to affirm on a piece of paper, I am not doing any DEI, and then you have internal DEI programs, it's just going to be challenging for you, even if you have the law on your side. And moreover, you know, the federal government, I suppose, could choose to try and take its business elsewhere, putting billions of dollars of contracts at risk for all these contractors. Companies are really in disarray. They're speaking to their lawyers, they're speaking to advisors, trying to figure out exactly how to deal with this, and Citi for sure is one of them.
We've seen this trend from Wall Street to Silicon Valley, right? How sort of devastating is it for diversity and equity inclusion efforts?
Well, perhaps for DEI as the acronym is a different answer than for diversity initiatives across the board. So I will note that Citi's decisions here, including on things like aspirational demographic targets, you know, these are coming directly from their lawyers saying you can't do this. The government is going to say this looks too much like a quota, which is illegal in terms of considering race or gender or things like that in hiring. And so you need to pull everything back. But there are other bits and pieces that remain. There are mentorship programs, internship programs, and simply the way the company treats its employees, offering benefits to LGBTQ individuals that aren't even necessarily afforded to them under federal law. It's going to be really interesting to see what they do with those policies that are, at least at the moment, a little beyond the scope of these rules. I will say that Coca-Cola also warned about the possible impact of getting rid of DEI in just a statement just now.
So, Simone, how does this differ perhaps company by company in terms of more domestically focused companies, and what does it mean for multinationals, for example?
I mean, if you're a domestically focused company, you are not just looking to the federal government, but you're also looking to the state government, because places, especially blue states, have certain laws, especially with respect to LGBTQ individuals, that you're going to have to try and comply with at the same time as you're complying with federal government laws. And, you know, officially the rule is there's no discrimination, but certain things like bathroom policy, can a trans person go to the bathroom that matches the way they present? Those are open question marks, and they're trying to sort this out. But you bring up multinational companies. This is a conversation that I've heard a lot of lawyers talking about, because different jurisdictions are going to require things like quotas in some cases in places in Europe, certain policies to promote staff based on things like race and gender in a way that had never been legal in the United States, and certainly one that the Trump administration will likely try and come after. I think it's just a real challenge. There's great business for lawyers right now, especially employment lawyers in this space.
Our Bloomberg News equality reporter Simone Foxman there in New York. More ahead coming up on the Asia Trade. This is Bloomberg.
You're watching the Asia Trade. Norichun Kim Bank has widened its loss forecast and named the new chief executives as a Japanese lender tries to recover from its foreign bond investment debacle. CFO Taro Kitabayashi has been chosen to replace Kazuto Oku as CEO from April 1st. Nochu now sees a loss as high as $12.7 billion in the year ending March, but expects a return to profit next fiscal year. Walmart is forecasting lower than expected profit for the full year, a signal that the world's largest retailer isn't immune to global economic and geopolitical risks. The company also cites uncertainties related to consumer behavior as a reason for its cautious outlook. Walmart's guidance does not include the potential impact of tariffs, which remain a big question mark for retailers. Rivian shares jumped in late trade after the EV maker posted its first ever quarterly gross profit to close out 2024. The fourth quarter figure of $170 million came in well ahead of Wall Street expectations. Still, Rivian's guidance for unit sales this year was below estimates as changes to tariffs, EV, tax credits, and other policies may impact turnover. We have more ahead on the Asia Trade. This is Bloomberg. We have breaking news out of Japan. We are getting the core CPI numbers for January coming in at 3.2% growth year on year. The acceleration slightly faster than the expected 3.1%. Still an acceleration from the previous month. The headline CPI year on year acceleration of 4%, which is acceleration from the previous month and really broadly in line with the estimates of 4%. Take out not only food but energy prices as well. It's an acceleration to 2.5% for the month of January, coming in line with the estimates. Of course, core CPI is a number that we're watching, and take a look at the Japanese yen right now. Not really doing much, perhaps a little bit of paring back of that earlier strength at that 149 level, getting to that 150 again. Of course, we're expecting these CPI numbers to be hot. Already surging food prices have really pushed up head inflation towards that 4% level at which we're right now. out, but core CPI year-on-year surprising slightly to the upside, growth of 3.2%. But of course, the implication, Haidi, is really to do all with the Bank of Japan at a time when yields are also surging.
Yeah, and of course the implications in terms of how quickly they can move from here, what that means for the yen. Let's bring Garfield Reynolds, who leads our Markets Live Asia coverage. So stripping out energy and food costs, again, you've got a reading above 2% for what, the fifth straight month. So does this give, a bit more of a green light for the Bank of Japan? Does this mean that it is becoming more entrenched?
I think there's about 10 green lights sitting there for the Bank of Japan. When you just look at the basics of the data setup, we've had signs of strengthening wages, the economy is doing well. It's very, very hard to plausibly argue that you don't have sustained inflation above 2%. So that would be calling for a hike at the next meeting. That's very unlikely to happen, but we do have some indications in recent BOJ speak from a couple of the deputies and from Ueda himself. Also, the Japanese government is sounding less worried about what interest rates might do to the economy. So given all of that, the case is continuing to build for sooner rather than later on BOJ rate hikes. And we saw the yen jump a bit quite strongly initially straight sort of around the CPI release before fading. I think that speaks to the idea that the data picture was very solidly in favour of BOJ moves sooner rather than later. So now it's very much up to what does the BOJ say? What does it signal about what's happening?
What is the BOJ thinking of right now? Is it just the rate differentials, the weakness of the yen, or now the strength of the yen? Or is it also to do with what could potentially come from the tariff impact of the Trump administration?
Well, that latter has been a big part of their thinking, and one of the themes of this week out of a range of central bank meetings around Asia has been concerns about the uncertainty being created by what's going on with tariffs out of the US. When will they come? What will they be? Will they turn out to just be bargaining chips, or will they turn out to be a substantial alteration to the global trading system? So all of that is helping to push central banks to sort of hedge their bets, if you like. We had both the RBA and the RBNZ cutting rates this week, but signalling they weren't so certain about the path forward. I think there's some air of that instinctively with the BOJ. Hiking rates in a determined fashion is not something that any BOJ governor has done in a very, very long time, if at all. So they're always going to be more cautious than others, especially because the yen has shown time and time again the capacity to really motor if it gets momentum behind it, and that would be something that they're concerned of. One of the other things they could be concerned about as well is that there's starting to be a bit of noise coming out of the US about concerns among some of President Trump's advisors that the US dollar is too strong, and that's part of the backdrop for the concerns about tariffs, about trade imbalances, and about the withering away of US manufacturing, which is something that Trump and Treasury Secretary Bessent have talked about wanting to reverse. So given all of that, there's a lot of pressures, competing pressures on the BOJ that's going to keep them tending towards tightening, but also concerned not to go too far too fast.
Bloomberg's Garfield Reynolds there. In fact, to Garfield's point, we actually heard from Treasury Secretary Scott Bessent, who's now saying that the U.S. is a long way from boosting the sale of longer-term debt, given current challenges, including inflation. Bessent tells Bloomberg that concerns over President Trump's tariffs being inflationary are also overblown.
The previous administration shortened some of the duration, and we haven't shortened it further. We've just kept the policy in place. And I believe over the medium term, it's going to play out as it becomes clear that everything that President Trump's administration is doing will be disinflationary. We're going to bring down energy costs. We're going to bring down regulation. What DOGE is doing in terms of cost cutting. And I think once the Tax Cuts and Job Act is made permanent, then we can have a revenue increase, cost decrease, and as you said, as the nation's top bond salesman, I got a pretty good story.
So what's the medium term? Help me understand that. What is the medium term? And then once you see all those things, let's say those ambitions become reality, then do you start to think about terming out the debt?
Sure, but that's a long way off. And we're going to see what the market wants. As Lisa noted this morning, and it's fun to see someone who believes that Fed minutes are exciting, that the Fed said that they may stop their balance sheet runoff. So easier for me to extend duration when I'm not competing with another big seller.
So when do you think that time would be? End of the year or further down into the administration's term?
Yeah, it's going to be path dependent. We're still seeing sort of the residual Biden inflation that's still coming through, and I think as the market starts to realize what we're doing, and inflation starts to drop, then we will see. So it's going to be path dependent. That's the eventual goal, but I'm not going to signal it now.
When you mentioned the Fed minutes, participants indicated yesterday that one of the problems they had was they were waiting for Trump policies to come into place. Do you think that those policies, when you think of tariffs, potentially deportations, immigration, this can be inflationary? Is it going to hold back the Fed from cutting rates?
Well, to the extent that Team Transitory at the Fed is still has any credibility, I would say that tariffs, if they have any price adjustments, are the most transitory thing there are. So I don't think that should hold them back very long. And I would point out that depending on what number you want to use, 10, 20 million people who came across the border, we had the worst inflation in 40 years when we added 10 or 20 million people. So I'm not sure why people are saying that it's inflationary to tell them to go home.
U.S. Treasury Secretary Scott Bessent there speaking with our colleagues on Bloomberg Surveillance. Well, the RBA Governor Michelle Bullock says the central bank is closely monitoring the labour market as persistent tightness may signal a stronger underlying impulse in the economy. Bullock is speaking at the moment before a parliamentary panel in Canberra. Our economy reporter Swati Pandu joins us now for the latest. And of course, when we spoke to Deputy Governor Hauser yesterday, he said it's really hard to see the bad news when it comes to the labour market.
That's right. They are sounding a bit more cautious increasingly since they cut the interest rates on Tuesday. And since then, we've had the labour market data, which showed that employment growth grew at twice the pace that economists had expected. And even though the jobless rate has gone up to 4.1%, it is still very low by historical Australian standards, but also from an international perspective. So the labour market remains really tight. And Michelle Bullock was talking about the uncertainty, the extent of uncertainty of the spare capacity and how little information they have around that, and whether that leads to reigniting price pressures and wage pressures.
And one of the things that you spoke to him about yesterday is this idea of, what happens to naturally tightening financial conditions? How do you get to that 2.5%? Does an unchanged rate bring it to that point? And she's been talking around that as well.
Yes, she just, in fact, spoke about it 10 minutes ago. And she was actually, I thought, more stronger in her opinion than Andrew was yesterday because she said if you leave interest rates unchanged, even in that scenario, they are not hitting the midpoint. So basically, they are going below the midpoint, so they are undershooting the target. So what she was trying to say is that with where the interest rate path is, they don't really know, because if they cut, then they are overshooting. If they don't cut, they are undershooting. So they really have to feel their way down. They will have to really wait for the data, see how they are, how the monetary policy response is in the economy, and then move cautiously. And that's why there's so much caution in their words.
And she's saying sort of so far so good, but there's a lot of sort of elements that could come into play, from extra spending from the government to global trade wars that could have implications.
Yes, absolutely. And trade is one big uncertainty, right? And Andrew Hauser was talking about that yesterday as well, when he said, we know that there will be an impact on economic growth. We know there might be an impact on inflation, but we don't know what that impact will be, whether inflation will go up or down as a result. Economic growth will get hit, but how much? We don't know. How much will China get impacted? How much will that hurt our exports and iron ore? There's just so many question marks around it that it is really hard to be pre-committed and to say that, yes, the next move will be down. They don't want to say that.
Yeah, tricky times to be a central banker. Our economy reporter, Swati Pandeyas, will continue to watch that parliamentary testimony from the RBA Governor, Michelle Bullock. More ahead on the Asia trade. This is Bloomberg.
Take a look at how we're setting up for the major market opens across Asia. We do have the ASX 200 gaining slightly in early trading right now, but Nikkei futures pointing to the downside. We had core CPI numbers surprising to the upside, growing 3.2% year on year for the month of January. Of course, we do have a much stronger Japanese yen at levels that we haven't seen since December. And of course, overnight, U.S. futures not doing much, but overnight we were watching those Chinese ADRs, the Golden Dragon Index at a one-week high, and really a lot to do with Alibaba, of course, rose more than 10% in New York, its biggest intraday gain in almost 2 years. They just announced their fastest pace of revenue growth in over a year, and there's a lot of optimism and expectation over their artificial intelligence drive. Now, the CEO Wu talking about artificial general intelligence as their primary objective. Our next guest is on one of his regular trips to Asia to take the pulse of AI spending trends. He's seeing another 12 to 15% acceleration in the supply chain across Asia around AI spending. Joining us here in Hong Kong is Dan Ives, Global Head of Technology Research at Wedbush Securities. And so
Great
good
to
see you
Great
in person.
To be here. Yeah.
I mean, I don't even remember we've ever met in person, I think.
I mean, it would be many years ago.
Yeah,
many years ago.
This is so cool. And we're both in Hong Kong at the same time. You've been doing this massive tour across Asia. What are you seeing around AI spending then?
I think it's just starting. I mean, if I look at demand's accelerating even from October. I think 12 to 15% increase. From an investor perspective, even those that were skeptical, now they're all in, because you cannot deny there's a fourth industrial revolution taking place. I mean, you obviously see Alibaba and others, but this is just the start of what I believe $2 trillion of AI capex next 3 years.
And yet, when you hear from the likes of CEO Wu, for example, and other companies, they're not necessarily laying out the use case for AI other than enhancing their services or maybe data centers. Does that tell you a little bit about spending trends from now on, or?
Yeah, I think, look, if you think about this AI revolution, it's being led by godfather of AI, Jensen, NVIDIA, on the enterprise, on the hyperscalers. But look what's starting to happen with the use cases. Names like Palantir, ServiceNow, software, across the board. When I look at Baba, I mean, Baba, in our view that ultimately it's Apple and Alibaba, that's going to be the partner in terms of Apple Intelligence. The consumer piece is just starting. That's why I think for Alibaba, this is going to be a massive renaissance of growth as it all plays out. And I think this is something, we are less than halfway through tech bull market in terms of our opinion.
It's quite interesting. We were talking earlier with John Authors about how compelling the sort of DeepSeek impact is on a medium to longer term, right? It seems like it's petered out a bit in the US. It seems like the bigger boon has been for China tech, like Alibaba, as you say. Would you agree with that? Or do you think it fundamentally just kind of plants more of a seed over the question of valuations and use case and, you know, ultimate sort of market sort of business case when it comes to the amount of investing that has gone in the US in particular?
Yeah, I mean, look, I've never viewed DeepSeek as a negative. I actually view it bullishly in terms of what that means for GPU capacity, in terms of hyperscalers, and actually ultimately even just more chips and more innovation, both in the US as well as in China. And my view is that it's not a zero-sum game. It's not China or U.S. in terms of success. I actually think China tech has been undervalued relative to the opportunity. I think DeepSeek shot across the bow, but it is just starting the innovation curve. And I think U.S., what you're seeing now is just that upping of CapEx. And that's a great thing in terms of for every dollar spent on a NVIDIA chip, there's an $8 to $10 multiplier across the rest of tech.
Are you more bullish? Would you say that it's more of a compelling argument in China, given that there's still catch-up to do from, you know, where we saw the highs of Alibaba's stock price, for example?
I mean, I think DeepSeek's the best thing that ever happened in China tech, because my view is that it's just starting this innovation that's going to happen across the whole big tech ecosystem, whether it's Baidu, Baba, JD, Tencent, however you want to think about it. And we're in a fourth industrial revolution playing out across the world. And when you look at what we're seeing on U.S. tech in terms of spending in China, no big tech player, regardless of where they reside, could just basically shrug their shoulders and not wait in line in terms of going down this AI path. And that's where I see it. I still believe investors are underappreciating the broader scale, what this is going to be for the second, third, fourth derivatives of AI.
Especially given that you were talking about Palantir, for example, earlier. Are we talking about software stocks, ServiceNow, and just a broader use of AI?
Well, I think you have to think about it like, okay, it starts off with NVIDIA, goes to the hyperscalers. You talk about the monetization. Palantir, the reason they're the Messi of AI, it started with Palantir. And look, the bears, they hate it 12, despise it 100, right? I mean, the bears they can never find AI in the spreadsheet, so they're always going to be negative on it. But you cannot deny the monetization that's happened from Palantir to Salesforce to ServiceNow to software. Because software is the monetization. I think eventually that's going to be cybersecurity as well. And that's why in this AI party, it's still 10 p.m. and it goes to 4 a.m.
Tariffs, export controls. What sort of uncertainty do they add to the sector? And could we see a parallel sort of supply chain that's already been built out that is going to actually boost and multiply the sector? Or are we going to see more difficulties in order to make these technological advances?
Yeah, I think bark's going to be worse than bite when it all plays. And I think with Trump, remember, this is all a game of high-stakes poker. So whatever the first sort of move is, you almost have to trajectory out what is the fourth, fifth move. I mean, I think you'll have actually something in some of the broader U.S.-China trade negotiations. I do not believe that this, from an export control, is just going to get worse and worse. It's going to dent the AI revolution, retaliatory. And I disagree. In my opinion, it's actually going to get us better to something where you could have multiple supply chains, but it's not going to be that sort of negative black swan event. And I think that's why in this Trump White House, the street and the stocks are telling you something in terms of their resiliency.
Talking about the Trump White House, we talk about Tesla a lot. Everything else that Elon Musk is doing right now and taking on, is that an overhang on the company?
I mean, I think the bet for the ages was the bet that Musk made on Trump. And you could argue, that bromance is going to continue because ultimately for Musk, autonomous is the goal. I believe that's worth $1 trillion alone in terms of the valuation. Regulatory is going to change. The Doge distractions, the worries about the brand issues, I think that's very contained. And in terms of the broader scale of where Tesla's going, we think it's a $2 trillion market cap, ultimately over the next 12 to 18 months. I view this as noise. But as we've said, like for Tesla and Musk, Skeptics are always going to be there, but it continues to be. The best that ever happened to Musk was Trump.
Dan Ives, Global Head of Technology Research at Wedbush. Really good to see you in person again.
Thank you.
Here in Hong Kong, we have more ahead on the Asia trade. This is Bloomberg.
Take a look at how we're setting up when it comes to this final Friday session. We are seeing the ASX 200 trending a little bit to the upside. We've had several sessions of negativity when it comes to this week for the ASX, still coming off record highs. So as we continue to hear from the RBA Governor Bullock in her parliamentary testimony this morning, really talking about the fine-tuning when it comes to navigating this narrow path of easing. Nikkei futures off by just about 0.4%. We had the inflation print showing that inflation continues to speed up. Really, all these data points pointing to the fact that the BOJ is firmly still on that rate hike path. And in fact, that 4% number that we had in January is the highest in 2 years on the back of food prices, both fresh and processed as well. We are seeing S&P futures at the moment treading water, more or less. We heard from Scott Bessent, of course, saying that the US is a long way from boosting longer-term debt sales. We are broadly across the region, Shery, expecting some gains this Friday.
Yeah, those comments by Secretary Bessent sent Treasury yields down, the dollar down, the euro actually gaining ground and snapping 3 days of losses on the back of that downside for the greenback and, of course, the Japanese yen. Given, as you mentioned, those core CPI numbers really gaining ground and surprising to the upside, we have seen the yen at that 149 level, slightly paring back a lot of that earlier strength, but we're still talking about levels that we haven't seen since December, especially with more hawkish commentary coming from Bank of Japan officials. The market opens in Seoul and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens as we continue to digest that exclusive interview with the Treasury Secretary Scott Bessent in the U.S. Haidi, he seemed to be pretty optimistic about bond market performance, not to mention the disinflationary trends that he sees coming from the Trump administration's policies.
Contrast, of course, when it comes to Japan, where we're seeing the strengthening of these inflationary trends, right? Really, as Garfield Reynolds said earlier, there's multiple green lights now in terms of how confidently the BOJ could progress from here.
Yeah, the Japanese yen at levels that we haven't seen since December. We're talking about strength against the U.S. dollar as yields also continue to rise. The 10-year yield at the highest level since 2009. And we have already heard from the Finance Minister Katsunobu Kato coming out talking about how debt servicing costs going up could actually have an impact on Japan's finances. We're seeing the Japanese yen pare back a little bit of that strength that we saw overnight. And this after the core CPI number surprised to the upside. A very strong 3.2% growth year on year, above economists' expectations. But at the same time, a lot of that potentially having been priced in, given that we are expecting food inflation, food prices to continue rising. The Nikkei down 0.4% early in the session. But take a look at how the Korean stock market is coming online as we're also getting those first 20 days of trade numbers for the month of February, surplus of $804 million. Of course, what we're watching, exports rising 16% year on year, imports rising 7.7% year on year. That's very interesting because we will continue to watch the export numbers for South Korea, bellwether for the rest of the world at a time when we, of course, do have the Trump tariff threats on everything from automakers to chip makers. And this, of course, a very important segment of the South Korean market. We're seeing the Korean won a little bit stronger at that 14.33 level against the U.S. dollar, Haidi.
Take a look at what we're watching when it comes to Australia, Shery. Of course, it's been a difficult set of sessions so far this week when it comes to equity trading. This is a market that's coming off some recent record highs. So given we are in the thick of earnings season, given that a lot of those heavily weighted miners have seen pretty depressing numbers being announced this week, unsurprising that it has been a pretty subdued week. At the moment, though, we're seeing kind of the ASX 200 just keeping its head above water as we continue to hear from the RBA's Governor Bullock. They're really talking at length about the labour market and really the way that it signals that stronger economy, also kind of balancing the rhetoric when it comes to the narrow path as they have started to cut rates this week and how they get that inflation within that target range sustainably. They've said that the bank is not committed to any kind of particular course of action when it comes to rates, given the evolving risks, of course, are many. This is a picture when it comes to Australian bonds trading at the moment, as well as energy prices, as we continue to watch that sort of tug of war between supply and demand downside there. We are seeing the likeliness of a weekly advance there when it comes to crude. The supply uncertainty side of the picture is clouding the outlook, and we could see that biggest gain since early January. Well, US Treasury Secretary Scott Bessent says he's in no rush to boost the share of longer-term treasuries in government debt issuance. He also told Bloomberg that President Trump's policies, taken together, will not revive US price pressures.
Everything that President Trump's administration is doing will be disinflationary. We're going to bring down energy costs. We're going to bring down regulation. What DOGE is doing in terms of cost cutting. And I think once the Tax Cuts and Job Act is made permanent, then we can have a revenue increase, cost decrease. And as you said, as the nation's top bond salesman, I got a pretty good story.
Let's bring in Ron Tamble, Chief Market Strategist at Lazard. Ron, really great to have you with us, particularly here in the Sydney studio. Is it a compelling argument that, taken as a whole, President Trump's policies are not at all going to be inflationary?
I think when you deconstruct it and you go through the major pieces, more of the pieces are inflationary than disinflationary. So in particular, I focus on tariffs. Clearly, we've already got a 10% tariff on all Chinese exports to the U.S. that went into place on February 4th. We have a whole schedule of additional tariffs that the president has talked about. On March 4th, Mexico and Canada have the end of their 30-day grace period. March 12th, steel and aluminum tariffs. April 1st, reciprocal tariffs. April 1st, the Treasury, Commerce, U.S. Trade Rep, and OMB have to release their report on global trade practices. And then we have April 2nd, the president has talked about tariffs on autos. Well, those all drive prices higher. And by the way, he's also talked about pharmaceuticals and semiconductors. So when you put those in context, it's hard to see how that could in any way be deflationary. And then if we add on some of the campaign promises around immigration enforcement, that's also likely to be inflationary. So it's not particularly compelling, at least on the surface, in my opinion.
I mean, April may as well be, 20 years away if you look at the sort of level of comfort that was in markets, right? Do you think investors are being too complacent and being just happy to kick the can down the road?
I think there is a complacency, and it's actually something that worries me quite a bit, because when you look at equity market valuations, with the S&P at 23 times forward earnings, with credit spreads at very tight levels, it is a market that's priced not for perfection, but for very good news in the future. And it does seem in my conversations with asset owners globally, most people, a substantial majority of people, believe that this is a negotiating position. It's bluster. Some people believe, it's for scoring political points. But I think the president and his team genuinely believe that the U.S. needs to reduce its trade deficit and that tariffs are an effective way to do that. So I guess I worry that people are not taking the president seriously or literally, and they should, because this has been a core conviction for many years for him and for members of his team.
And given all of those inflationary concerns, Ron, and the fact that we could see perhaps more moves towards safe havens, is that a given that we will see more strength for the U.S. dollar then?
Well, I'm never going to say it's a given, but that is my base case assumption. I mean, if we look at the likelihood of higher inflationary pressure from tariffs, additional inflationary pressure from immigration enforcement, and by the way, I should have mentioned, these are positives for the equity market. Deregulation, in theory, on the margin could add to growth. And if you have corporate tax cuts and the extension of personal tax cuts, Those could add to growth. So all of that adds up to more, more inflation pressures. And that probably means, in my view, that the Fed is not going to cut rates at all this year. The market is saying 38 basis points of cuts by year end. I think that will be a zero. And to get to your question, if currencies are driven by changes in expectations of interest rate differentials, I know that's a mouthful, but changes in expectations of interest rate differentials, then that should mean a stronger dollar. And by the way, I would note the converse, or the flip side of that whole argument. If we do indeed impose tariffs, as I think the United States will, that probably means lower growth in other regions and more rate cuts from those regions. So where the market says the ECB will cut by 78 basis points by year end, I think that's probably 125 basis points. So I do expect more dollar strengthening in the months ahead.
So given what you're saying, if we're expecting more U.S. exceptionalism, whether it's a dollar, are we expecting that also for U.S. equity markets? And would you stay put, or would you try to use this time in order to reallocate your capital?
I think actually this year is going to be a great opportunity for investors to consider some pretty important reallocations. I do think the U.S. equity market can continue, well, I was going to say continue to outperform, but if you look year to date, the DAX has actually done quite a bit better than the S&P. The CAC has done better. But I do think you will see U.S. outperformance over the next several months, because the pain of tariffs is actually more significant on the countries outside the U.S. than it is to the U.S. And so I think you could see some outperformance there. And as I mentioned, I think you'll see a stronger dollar. But in my view, this is going to be a great opportunity to move capital out of U.S. equities into other regions. For example, I think Japan has a very good story. Obviously, we just got solid inflation numbers again this morning. I think you're going to get positive news out of the Shunto wage negotiations this spring. So I think Japan is one place people should be looking. I also think emerging markets ex-China could be a very good place to put money. On a long-term view, in terms of capital shifting away from China to avoid that geopolitical tension and looking for other low-cost places to manufacture. So I think that would be one choice. And then the other, by the way, is it's probably a good time to be on the margin, taking capital out of some of the high-flying tech stocks, the Mag 7 and friends, and moving down the cap spectrum as earnings growth broadens out in the U.S. this year into other sectors, and you get better performance beyond that very narrow group that led the market for the last 2 years.
Why ex-China? You take a look at Alibaba overnight. I mean, is China tech looks like it's back?
Now, the challenge with China, I think it's a market you can trade. But what I'm looking at here is a structural alpha story, in my view, of capital moving. You look at 3 of the last 6 quarters, foreign direct investment into China has been negative. If you look for the 15 years through 2021, 100% of FDI into emerging markets went into China. I think over the next 10 to 15 years, a substantial majority of that will go to EM ex-China. Now, the risk of my call on EM ex-China is exactly what you just said. You get these severe rallies. We saw this last year in February through May. September 23rd of last year, we saw this Chinese equity market rally over 30% in a short period of time. And I do recognize there are high expectations out of the National People's Congress, the 2 sessions in March. My worry is that the downside or the risk of an EM ex-China trade is you could miss a pretty big rally in Chinese equities. But my conviction is until China makes major structural reforms, those growth spurts are going to be short-lived, and you want to trade those rallies. It's a rent, don't own.
Ron Temple, Chief Market Strategist at Lazard. Always good to have you with us. In fact, we actually saw that pretty big rally, at least overnight, when it came to Alibaba. The U.S.-listed stocks surging on their fastest pace of revenue growth in more than a year. Let's get more with our tech reporter, Annabelle Drewler. Annabelle, of course, there's a lot to unpack, but let's talk about their biggest and most important divisions.
Yeah, so there's the e-commerce side, and then there's also what they're doing in cloud. But I'll kick off with, I guess, e-commerce. It is the bread and butter of the business, and it's been a very interesting turnaround strategy that the company has pursued, because you think just a couple of years ago we were talking about splitting off the empire and listing these 6 different business units. They've been under new management, and it seems like that back to basics strategy has paid off, because we saw revenue for Taobao, Tmall picking up substantially. That came in at just 4.8%. It was expected to have risen around 2%, so a strong beat there. But the cloud division was the one that we tracked really in particular, because we saw very strong growth there for that, up 13%. It was the fastest pace we'd seen in 2 years, and really helped by what has been triple-digit growth in AI-related products. And executives are saying there's a lot more to come.
Yeah, especially when it comes to AI, right? And that shift that you mentioned from the traditional model. What can we expect in terms of artificial general intelligence as their primary objective?
Yeah, well, it's very ambitious. You could say that for a start, because I think we need to sort of caveat that with people would say AGI may never happen, or it could be decades away. But they're really putting it front and center for their objectives, and it sort of speaks to their broader AI focus as well. Because yes, cloud revenue, but as it stands, Alibaba is the only player in Chinese AI that builds its own models, it builds its own data centers, it runs a cloud service, and it funnels capital into AI startups like Moonshot, Minimax. I mean, it's got a suite of ones that it's invested in so far. And so it's a portfolio that's kind of similar to Microsoft. That's how you can kind of think of it. But yes, that is what the CEO Wu said on the call, that they do want to be able to build AGI. And again, it just speaks to that greater focus on AI moving forward.
I mean, we do have to wait for the market opens in Hong Kong, but so far overnight, investors like what they heard.
Yeah, we saw a strong market reaction. I don't know if we can say good, but we saw it moving higher. Essentially, it closed up around 8%. It's been, yesterday, Mark Ramfield from our MLive team had a really good way of putting it. He said that NVIDIA's earnings are like Alibaba's earnings are like the NVIDIA for the Hang Seng. That's how important it's going to be for general market sentiment in Asia today. So it'll be really interesting to watch how trading starts in China, and whether, just taking a look at the Nikkei down fairly flat right now, interesting if it starts to turn sentiment around a little bit. But we actually have as well seen some interesting investors moving in or continuing to build up their stockpiles as well. We've got Cohen, for instance, a known meme stock king. He's now boosted his stake to around $1 billion. That's what the Wall Street Journal was reporting. But people are quite bullish on Alibaba.
Yeah, the fact that they gained about $100 billion of market value just this year, that's incredible. Annabelle Jewelers here with the latest of Alibaba as we head towards that market open in Hong Kong. This is Bloomberg.
I do have my first call with my Chinese counterpart tomorrow morning, so I look forward to a very productive discussion.
What's the first point you want to bring up?
That we want to work together, and as we've said, a lot of the precursor ingredients from fentanyl originate in China, so we really want to put a stop to that very quickly.
U.S. Treasury Secretary Scott Bessent speaking to Bloomberg Surveillance. Bessent also repeating that China needs to rebalance its economy ahead of that phone call on Friday. For more, let's bring in our China correspondent, Mimi. So what more can we expect from that call?
So Bessent was saying that the only agenda on this call is fentanyl. But whether he will make progress on that call is a big question, because the Chinese embassy in the U.S. has said that China already has given a tremendous assistance to the U.S. on this issue. And yes, granted, China has already taken steps to close the loopholes, to strengthen supervision when it comes to fentanyl. They have also given U.S. officials, law enforcement officials, a greater role when it comes to investigating these smuggling rings in China. Some of that effort has been halted when ties soured, but they were restarted at the late stage of Biden's administration. But clearly, Trump administration is saying that that is not enough. And Trump has said in his executive order, it was written there, that the U.S. believes China has the most sophisticated surveillance mechanism in the world and a very strong law enforcement mechanism. So if they so choose to, they would be able to put an end to this fentanyl crisis. So both sides have very different starting points here. Whether they could come to a compromise, that's something that we have to keep a watch on.
Yeah, and of course that has big implications when it comes to tariff negotiations.
Yes, as you heard there, Scott Bessent also mentioned the imbalanced economy. He's reiterated that point several times, saying that China has the most imbalanced economy in the history of the world and that China is exporting its way out of recession. His words, not mine. But Trump has signaled that he is willing to cut a deal with China, but no details on the shape and form of that. And so far, based on China's very carefully calibrated retaliation that has been seen as largely being less proportionate to the scale of the U.S. tariffs, there is signal that China wants to tone this down as well. But you add to that the question of whether these tariffs are an end in themselves to raise revenue for the U.S. in lieu of tax cuts. Plus, you throw in Ukraine into the mix. Does Trump require Xi's help to end that war, to help with reconstruction effort post-war? Or does a leaning towards Putin from Trump, does it come at the expense of Xi, because it at the same time would refocus the entire attention of the U.S. military to China and its alleged aggression in the South China Sea, to the Taiwan issue? Remember that the State Department recently removed a phrase that says the U.S. does not support Taiwan independence. That phrase had been removed from a fact sheet, although the U.S. outwardly still say they support the One China policy. So many moving parts here. And again, we just have to stay tuned for how those negotiations go.
Bloomberg's China correspondent Min Min Lo there, taking a look at some of the other geopolitical stories that we're following. And Scott Bessent also signalled that sanctions relief for Russia could be on the table in talks over the war in Ukraine. The Treasury Secretary told Bloomberg that Washington is prepared to either ramp up or take down penalties based on the Kremlin's willingness to negotiate. Bessent also criticised the Ukrainian President Vladimir Zelensky for suggesting that President Trump is misinformed about the war.
A lot of his remarks in Munich I thought were inappropriate. President Zelensky, when I met with him, assured me that he'd be signing the minerals deal in Munich. He has not. And look, the real purpose here, and I think it's turned into kind of this media circus, that President Trump had a very elegant plan.
Well, South Korea is seeking to implement tariffs on some Chinese steel products due to concerns over an influx of cheaper products flooding the market. The proposal includes a provisional tariff of up to 38% on hot-rolled steel plates imported from China. The levies will take effect once approved by the Finance Ministry. Hong Kong's oldest pro-democracy party will call a vote on whether to dissolve. The Democratic Party's chairman says a committee will work out a timeline for the process. He says the move is based on their understanding of the current political situation. The party was founded in 1994 and was among the city's leading opposition forces before Beijing's national security crackdown on dissent. Well, Germans head into a crucial national election on Sunday with an economy at breaking point. After a campaign that's exposed deep divisions on issues including immigration, Bloomberg Originals has been taking a closer look at what's polarising voters. Here's a preview.
For decades, Germany meant heavy industry, exports, mining, a rock-solid bond market, and reliable, steady growth.
The idea of post-war Germany was built to a large extent around economic well-being and prosperity. That prosperity promise has failed and disintegrated.
Since 1950, Germany's economic story has been one of year-on-year growth, or it mostly has if we ignore COVID, the financial crisis, and some one-time blips. Only twice in this period has Germany's economy contracted during consecutive years, once between 2003 and 4, and just now. And while these yellow bars show a tiny bit of forecasted growth, even that's already been revised down. And since the financial crisis, Germany's had strict limits on how much additional borrowing the federal government can take on, equal to 0.35% of GDP. Or put another way, the smaller the economy, the less new debt available to put towards stimulating it.
Subscribers can watch that report in full on the terminal or on our website. It'll also be posted later on the Bloomberg Originals YouTube channel. Do join us this Sunday for special live coverage of Germany's elections here on Bloomberg Television. Take a look at how futures in Europe are opening up at the moment. And this is a picture, as we saw in the previous session, stocks in Europe dropping as investors really weighing the impact of earnings as well as the talks over Ukraine. Some European companies did report stronger earnings, Schneider Electric, for example, but there were some disappointments as well, in particular from Airbus and Carrefour. German DAX futures looking a little bit negative as we get that risk aversion ahead of that weekend vote, but we have seen some analysis suggesting that any post-election rally in German stocks could benefit those mid-caps more than the broader DAX. You see that huge gap really beginning to close between the two indexes there. Well, more ahead on the Asia trade. This is Bloomberg. Well, mining giant Fortescue says it's still optimistic about China despite seeing softer iron ore demand. CEO Dino Otranto told us exclusively about why rising trade tensions as well are not much of a concern for their business.
We've been in China since we started, more than 20 years, and we take a mid to long-term view, and certainly the fundamentals of China are amazing, really. 5.5% GDP last year on a much, much bigger base. And we're seeing the government really step in to make sure that that property sector is supported, coupled with the diversification that we've seen over the last 5 years into higher-end products, and the automotive industry can speak for itself, and it's consuming a lot of steel. So we're really excited, actually, about China.
But then how do you layer in the tariff story? Because Donald Trump says it will be possible to reach a fresh trade deal with China, but then you've still got the 25% steel tariffs to factor in. So how do you plan around all of that?
Yeah, so we call it Trump version 1, the first time around with China, and we've seen China really respond structurally to diversify around its exposure to the US. So we believe the tariff situation, wherever it may land, it's early days, is not that much of a concern, particularly for our products, which have a high degree of liquidity going into China.
Fortescue CEO Dino Otranto speaking exclusively to Bloomberg in London. Take a look at broader commodities right now, because we are looking at iron ore, which was pressured throughout the week. We had seen major miners, including Rio Tinto and Vale, posting declines in earnings, and prices fell. Of course, we continue to watch China's property crisis and just demand concerns overall. We had copper closing slightly higher in the London session. We continue to see the broader metals market as we are headed towards those tariffs on aluminum and steel. Oil set for weekly advance. Supply uncertainty also clouding the broader outlook there. WTI up 0.2%. This is Bloomberg. We're getting PMI numbers out of Japan. The preliminary data for February, the composite 51.6, above that expansionary territory for the number, and this is for a 4th consecutive month. When it comes to the manufacturing PMI, 48.9. We've been in contractionary territory since July of last year. Services PMI 53.1, improving slightly from the previous month. Of course, earlier today, we had seen the CPI numbers, headline inflation accelerating to 4% in January, the highest in 2 years. And you can see right now the Nikkei under pressure, 0.2%, as the Japanese yen continues to trade around that 149 level, paring back some of those earlier gains, but still at the strongest level since around December. Let's get more on the outlook for Japan's economy and the BOJ's rate path. Bloomberg senior Japan economist Taro Kimura joins us now. Taro, interesting the Japanese yen reaction to the CPI data, because the number was pretty strong, but was it broadly in line with expectations?
Right. The trick for Japan's CPI data is the move is almost predictable from the Tokyo's CPI data that was disclosed a few weeks earlier. So I think just investors were relieved that, the national print just followed what we observed in the CPI. So therefore, there wasn't a lot of move in the market right now, I guess. But at the same time, it's true that, the January CPI print is really hot, particularly with the food prices. And when you're living in Japan, you can feel in the daily lives the food is getting more expensive, which spill over to services such as dining out fees, like sushi, pork cutlet meals, gyudons, which is actually a CPI items in the data. So I think the BOJ is alert to a spike in food prices spill over to broader items.
How do you feel about the momentum when it comes to the Japanese economy at the moment, if you take a look at the most recent indicators?
Right. The various indicators point to strength, of recent Japanese economy's momentum. For example, the wage data, not just because of the strong base pay rises due to a Shunto negotiation, but also the stronger winter bonuses surely bolsters the income, which do spill over to recent private consumption in Japan, which was part of the reason that the fourth quarter GDP data surprised the market. And regarding the wage data, more is coming and the inflation is getting hot. So therefore, we think the deflation or disinflation is now history in Japan and the economy is getting normalized. Therefore, that will give BOJ more reasons and leeway to normalize policy further.
Is that the reason why every time we get BOJ commentary these days, they sound a bit more hawkish, perhaps even no concerns about rising yields at least, which could potentially point to this tightening path that we seem to be on very firmly at this point?
Right. I think the baseline message from the BOJ is, hey, economy is getting healthy and we have enough inflation. The yields are too low compared that, given that the inflation is above 2% and the current policy rate is 0.5%, so it's still negative in real terms. So the BOJ also now officially alerts to the concern that they're stimulating the economy too much. For example, the quoting, the rise in the real estate prices, as well as the possibility of making the life of zombie firms longer. Those are actually set by one or more board members officially. So therefore, I think what the BOJ is thinking about the bottom line is it's healthier for the economy to have higher yields.
Our senior Japan economist Tara Kimura there. Take a look at how Asian markets are tracking. We're just about 35 minutes into the start of trading in Japan and in Korea, and an hour and a half here into the session in Australia. We are seeing the Nikkei 225 a little bit softer, about 0.2% there. We are seeing some strong gains when it comes to healthcare, utilities, energy also gaining as we look for another weekly gain for crude prices. But tech, industrials, consumer stocks seeing some weakness so far in the session. The Kospi also seeing some modest losses. Here in Australia, we're seeing a turnaround after a few difficult sessions of downsides as we have really some of that leadership coming through from banking stocks as well as mining staging a recovery after a series of pretty difficult earnings as well. Well, the Deputy Governor of Australia's central bank says policymakers are still rigorously focused on inflation, although no single piece of data can trigger a rate move. Andrew Hauser spoke with us after the RBA cut its key rate this week for the first time in 4 years, but did try to strike a hawkish tone on future easing.
There's been a great deal of positive news about inflation in Australia. Just to remind you, and you know this, we adopted a somewhat different strategy to tackling the inflation spike in Australia to other countries. We raised interest rates to a level we thought that were restrictive, but we didn't raise them to the sorts of levels that other central banks had done, precisely because we wanted to protect the gains in the labour market. And as I think you've been talking about earlier, labour data out show that the labour market in Australia has been incredibly strong, but inflation has also come down as well. What we said in December is that we would form a view about whether we become sufficiently confident that inflation would come sustainably back to target, to the midpoint of the target, 2.5, to begin easing. We did reach that position of sufficient confidence, but this is not a done deal yet. The underlying rate of inflation is still 3.2%, which is slightly above the band. The headline rate of inflation is in the band. And so although we've removed some of the restrictiveness that we had in policy, there is still restrictiveness in the system, and we still need to see a bit more good news on inflation coming back to that midpoint.
And the jobs data was quite nuanced, right? Because even though unemployment ticked up, even though we saw more jobs than expected full-time being added, participation is still really high. The wages data this week showed, further slowing. Does that tell you that some of that robustness might start to fade in the coming months?
Which bit of it shows you that it might fade?
That we're starting to see the signs of perhaps a little bit more vulnerability in the labour market. And of course, Australia's not the only one that's kind of dealing with that scenario.
It's quite hard to see bad news in the latest employment data. They remain very strong. I think the debate about the labour market is a slightly different one, which is, although we know employment has been growing strongly, inflation has been coming down. And as you say, wage inflation has been coming down too. And so there's a very lively debate about whether that employment growth leaves us with less capacity in the labour market or a bit more. If there is a bit more, then inflation will come down more quickly than we're predicting, and that'd be good news because it would mean that we can adjust policy more rapidly. But we need to see more information on that, I think, before we can be sure.
What do you see as the biggest risks facing the economy?
Anyone who tells you they know how this is all going to shake down in the long run is wrong, right? We're all learning. Things are moving very quickly. I think one of the important points I'd say is actually that very uncertainty about trade policy and about outcomes in general, globally, not exclusively in Australia, may itself have an effect on activity in Australia. So if you're a firm or if you're a household planning to make an expenditure that in some way depends on a certain outcome in the global economy, and you know that who knows what's going to happen in the next period, you might just wait. Now, waiting is very sensible for an individual, but it could be really bad news for the economy. So I think, for me personally, one of the factors in the decision this week was actually a sense that, look, maybe that pervasive uncertainty itself may have some short-term depressing effect on activity.
Deputy Governor of Australia's Central Bank Andrew Hauser there, who's also fronting Parliament in testimony this morning. More ahead on the Asia trade, this is Bloomberg.
Alibaba poised to become China's second largest company during Hong Kong trading on Friday. This coming after a surge in revenue growth and the blockbuster rally this week. The China Show co-anchor David Ingles joins us now in Hong Kong. Very exciting times for Alibaba.
Yeah, the irony of me being here this time, I think on Wednesday, when I was pointing to some of the technicals on Alibaba and saying things were overheated, and then the stock went up for the 15%.
You're not the only one, though. We saw from analysts that they were saying you should cut exposure.
Yeah, you should start trimming it. But then the earnings yesterday really gave us something else to think about, I think, when you look at what happened. So the stock went from about 47% year to date to now 60%. So that's probably going to show up in Hong Kong when things open up. The other, just very quickly, the other point I want to make is that in terms of this most valuable list globally, right? So we rank things by market cap. You obviously have Mag 7 at the very top. You have Aramco up there. Alibaba, and really for the most part, most of the Chinese tech giants have fallen back because of the correction in the last 3 years or so. In fact, Baba was ranked 100 plus as recently as 5-6 weeks ago. You know, over 5 weeks, it jumped 41 spots. It's now 67th in the world. I know that doesn't sound like a lot. But when you look at it into context, right, you look at it within the China context, it's actually now on track, and the chart's going to show you that, to overtake ICBC to become China's second largest company by market cap. ICBC is still slightly ahead currently, but I'm just extrapolating based on the 8% pop overnight. You know, any similar move today, even half of that in Hong Kong, would actually take this one home before the weekend. So that is certainly something to watch going into today.
Yeah, Bloomberg's David Ingles there here in Hong Kong with the latest on Alibaba and what to watch out for as the Chinese markets get underway in just an hour or so. But there's continued optimism, right, on Chinese stocks around artificial intelligence, around robotics as well. Sentiment, of course, getting a boost from President Xi's recent meeting with tech sector leaders. Local media this week also quoting the CEO of robotics firm Unitree, expecting a promising outlook for the sector. One company to watch is Deep Robotics, hailing from the same hometown as Alibaba and Unitree. It focuses on R&D and production of consumer and industrial AI robots used in sectors including everything from security and rescue as well. Let's get more insight on their business plans and technology. Joining us now from Hangzhou is Xiong Junjie, Director for Overseas Business at Deep Robotics. Really good to have you with us, and we're just watching those photos, that video of your robots, and it's really pretty cool stuff. How much do you expect this overall sector and industry to grow in the next year or so?
Well, we expect that this kind of machine will come into play of our day-to-day life, either in the life or the working environment, to have a ballpark number, we expect to doubling every year, at least from our perspective, or maybe can go even faster.
We have talked about uses such as emergency rescue, security measures as well. Do you expect the use cases to be extended, perhaps with the popular masses being able to perhaps own one of these robots very soon?
I believe that, as you mentioned, many of these user cases are emerging, and because the technology are getting easier to use and cheaper. So it gives you a expanding quantity of the application potential. However, to really make sense for everyone owning one of these will largely depends on how much progress we can have on the AI side of how it understands the environment, understanding the task, and even performing the task, and reduce the ease in terms of operation and the level of risk that evolve. So I believe there will still a reasonable time from today until a point that everybody can own one of these. But for any of these, the real application showing in the video, probably we can soon see that it pops up in many of these applications as the operator side, they are more proficient on the risk mitigation.
We saw a robotics maker founder, Unitary, participating in this high-profile meeting between President Xi and tech leaders earlier in the week. What do you take away from the signaling of this, right, in terms of policy support? Does it make you more optimistic that the government is going to make this a policy priority?
Yeah, we are very optimistic about the outcome of such a meeting, giving that in two directions. That first, we do have this encouragement in terms of trial in different sectors that the government is supporting, so that we expanding a larger base of application potential. And secondly, that definitely more funding will inject into our research work, so that we can explore a lot more of this edge technology come into combination of our platform that we are working with, so that we expecting a boom in our sales volume, and application-wise, a lot of new stuff will come up in the following months and in the coming years.
Tell us about your humanoid robots, right? What's the use case? How progressed is this? And what do you see the market as being?
Now, we do have our own progress about the humanoid, although it's not yet to be a product that available for a client to get it. And we do have a very found solution for applying humanoid in different terrain conditions. However, personal opinion is humanoid is still a complex system that most of the application-wise still have a curtain to go over, where it can be used to easily used to the level of a normal operator, not in the knowledge of the researcher, so that in the coming years we will have only a small volume of trying in different applications, and through that is a data collection process, and so we can make use of this data to improve our controller, reduce the difficulty in operation of the system, so that it will, after overcoming these difficulties, then we expecting a boost on the quantity application.
So as you enhance these programs, and also, as you say, you integrate artificial intelligence more into your machines, what sort of models are you expecting to use? Are we talking about perhaps you could be using DeepSeek models? What sort of conversations are you having?
When we talk about embedded AI for our products, we actually talking about two concepts. One is how we actually control those motors to make it move. That is some in-house developed controller based on machine learning and reinforced learning. So that is quite far away from the common understanding of these LLMs. But what we see now, those super smooth while action may controlled by our own model inside the machine. And on the other sense, as you just mentioned, DeepSeek, that will be more relevant how this machine will have a user interface with how to interact with other people, so that in the operation, in the perception of the environment and the human operation, that DeepSeek or any other LLM will start make intervention of the process, make it easy to communicate, easy to use, and more human-friendly interaction instead of control, command, or coding.
Are you looking at markets outside of China at all at this point?
Yes, we do have a very ambitious plan for expanding our overseas coverage since last year, and we are quite hard and working on that. And since beginning of 2022, we already have threefold of our overseas sales volume.
Really appreciate your time with us, Xiong Junjie, who's the Director for Overseas Business at Deep Robotics. You can watch us live and catch up on our past interviews on our interactive TV function, that's TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about, plus join in on the conversation as well. You can send us instant messages during our shows. This is for Bloomberg subscribers only. Do check it out. It is at TV Go. This is Bloomberg.
Hong Kong's benchmark stock index is set for a reshuffle, stoking speculation that it may add names from healthcare and AI to maintain its recent momentum. Bloomberg Asia stocks reporter Sang Mi-cha joins us here in Hong Kong. So what are some of the names that may join the gauge?
Yeah, so this time it was really interesting because a lot of times we ask analysts, they always come up with tech, but they were coming up with AI specifically. So AI is really everywhere. And they were naming some of the names like SenseTime. This is a stock that has its own artificial intelligence model, including SenseNova. And its stocks rose 36% intraday sometimes last year, depending on how the performance of their artificial intelligence did. So there's a lot of interest there. But of course, biotech and healthcare is definitely an industry that is underrepresented in Hang Seng Index. So that's always the names that come up. Some of the names are Innovent Bio. It's a company that develops its own obesity drugs. So, of course, when it comes to the GLP-1 market, it's almost like a duopoly between Novo Nordisk and Eli Lilly, but a lot of these Asian and Chinese names actually are coming up against them. And then there's Akeso, another biotech name that is working with Summit Therapeutics in the U.S., going after some of the cancer drugs against Keytruda, which is taking up 40% of the revenue from Merck. And then there are EV makers like NIO, and then just many other names that are raised. But of course, they might not have any changes. That was the case for 2 of the quarters last year. So, but ultimately, the whole goal is to increase the constituents to 100. Right now, we have 83. So we'll be watching later today. Yeah.
And we've seen the Hang Seng Index shooting up 20% since the January lows. Obviously, Alibaba is a big part of that. Are we starting to see some indicators of bullish fatigue, though?
Yeah, my colleague Abi was just saying that the interest, all kinds of money are interested in Chinese stocks right now. And of course, a lot of that interest is reflected in Hang Seng Index. Just like you said, it's risen 20% from January 13th, and we remember that the Hang Seng Index was losing for 4 years consecutively until last year when it gained about 18%, and we are already seeing that jump this year. So, and a lot of the bullish calls happen, we've been seeing that in Wall Street brokers. A lot of them are becoming very bullish, and we are seeing that in U.S. options market as well. well. When we look at some of the key ETFs in the U.S. that's investing in Chinese stocks, we see that some of the contracts have doubled, and that was ahead of the Alibaba earnings, but also just a lot of catalysts we're seeing when it comes after the symposium especially.
Bloomberg Asia stocks reporter Sang-Mi Cha here, of course, watching out for the Hong Kong market opens, as we'll also be watching Alibaba as well, given that huge surge overnight on the Wall Street session after they announced the fastest pace of revenue growth in over a year. And you can see TAIEX futures to the downside of 0.1%, while U.S. futures not really doing much after stocks fell from that all-time high. That's it from the Asia trade. The China show is next. This is Bloomberg.